I apologize for the attire. I promised a nonchalant last weekend with Josh, and we're live with the dress shirt.
We're looking good.
So
We're looking good.
you wanna go in?
Yeah. Episode two of So What If. This specific segment is specifically to do with kind of the situations that we deal with on a daily basis. We have clients calling us all the time asking about, so what if this happens? So what if that happens? So we wanted to have a little informal live stream outlining so what if situations, and this week had a bunch of them, and it's only Thursday, so we want to share those situations with you so you can maybe learn from these situations and have some questions answered along the way. If you do have any questions throughout this entire live stream, feel free just to leave it in the chat. Our handy dandy cameraman Peter's going to take a look and make sure that we can answer those as well. But let's get into the first one. First one is, so what if a developer doesn't have a cap on building overages? Now, this is something that we've seen frequently, specifically for developments that were going on during COVID. The cost of goods drastically increased, the cost of actually completing these projects increased, and all these projects are now closing. And if you purchased a property that didn't necessarily have a cap on overage costs, then you're stuck in a situation where you're closing, and this bill is something that all the people who purchased the pre-cons are actually on the hook for. It's really important to take a look at these contracts when you are buying it. Have your lawyer, have your real estate agent take a look to make sure there is a cap on overages. But I had a client this week who was on the hook for about $50,000-$60,000 in overages on top of the down payment that they didn't really plan for. So, that can be a dicey situation. Obviously, this person did have enough capital to be able to put that down, but it's not a little bit of money, and it puts you in a tough situation where you might have to ask for a gift from a family member to be able to make up that difference. In a situation like this, a bank wouldn't allow you to be able to draw from a line or take on more debt, especially if your qualification rates were at the maximum amount. So you'd be stuck in a situation where you essentially need to come up with the money from savings or investments, or have a family member give it to you, which not everybody has someone who can give them that kind of money.
Yeah. And we can try our best to make it a lighter burden. We do have some B-side solutions that allow you to use the appraised value. But still, if you have that little deficit, you still will have to come up with the cash to cover that, as Josh said, without taking on any additional debt to make sure your GDS and TDS remain in place. So, yeah, that sucks.
It does. And it's happening more frequently. So if you are in some sort of contract right now, maybe take a look at your contract if you still have a year or so to close on it. Run through, make sure there's a cap on those overage costs, because it might be something that you might have to deal with down the road. Some developers are known for it, some aren't. Most of them are capped at like $10,000 or $12,000 bucks. It's still a lot, but when you just have an unlimited cap, it can become a problem.
Definitely pay attention to the contingency.
For sure.
A close eye on the contingency.
Yeah. Seems like the condo market, the investors in the condo market are the ones who got the raw end of the stick at the end of the day. Like, a lot of the challenges we're seeing are coming from those pre-con situations. Either you couldn't afford it, plan on wholesaling it, or signing it, stuff like that. So it seems to be, that's where a lot of the pain in the market is being felt right now. It's from the developer side, from the people who are speculating on the developer side.
Well, especially the last 2 years, because they were all kind of caught in that bubble too. So then they were purchased, or the prices were placed a little bit higher than maybe they were going to be. So, like Josh said, if you have something closing in the next year or two, we should definitely start looking at what may happen and what may occur, and just make sure we can mitigate it now, so that way it's less of a burden in 2 years or a year when you have to close. So that's a good one.
Yeah, for sure. Something that I haven't seen a whole ton of, and something that unique that we're running into more recently. So keep in mind. Second, so what if my spouse wants to prioritize paying off our rental property instead of refinancing and getting into our next one? What's the better move to make here?
Shout out to my mom. So, yeah, so, from our end, we obviously do talk a lot about velocity of money, keeping it going. The nice thing when you have a rental property is a lot of this burden is tax deductible. So, at the end of the day, if you go pay it off, you kind of lose that interest that you're able to write off at the end of the year. You're trapping a bunch of money into a property. I guess it depends. If the spouse is willing to have a HELOC put on it, then obviously you have access to those funds. But at the end of the day, it's a lot nicer to keep it going and build that nest egg for retirement. Obviously, strategy depends on the age you are and if you have that risk tolerance still at the end of the day. But there's many things like the Smith maneuver, which you could touch a bit on if you want to.
Yeah, the Smith maneuver, essentially what it is you lever up your rental properties and you pay off your house. Because you can write off the interest on the rental properties, and you can't write off the interest in your home. So you're saving all the interest when you pay off your home faster with refinance funds from your rental properties. If you are looking or are somebody who does want to have no mortgage on your home, highly recommend not making those giant lump sum payments. If you are going to do that, you have the accessible capital. Go invest in a property, force appreciate it, take some time to understand how that works. Once you do that, you can refinance it. That money is then tax-free money. As long as obviously the rental can support the debt, take that money, make that giant lump sum payment down in your house. A lot of people are in situations with fixed income. There's no way you're finding $300,000 in a mattress. So that is a great way to be able to pay off your house without necessarily pay a lot of income taxes and have to pay interest that you would have spent on. So, in our opinion, I would say learn how to invest in real estate, fundamentals work, purchase rental properties, and then if you want to pay off some debt, do it that way.
Yeah, it's also important, like when you're doing these moves, like you should have kind of talked about the strategy and aligned yourself with your partner's expectations. I think the main thing, if someone's more into the space than somebody else, it's all about aligning your expectations together to make sure there's no kind of brick wall when you try to make these decisions. And just being able to have a clear goal and focus on what you want to do is a lot easier to entice somebody to want to do that as well. If you don't really know why you're doing it and it's kind of just sporadic, then you won't get the confidence from somebody else to believe in what you want to do. So if you can clearly explain what you want to do, I feel like it makes that a little bit easier, especially for someone to do something.
For sure, partner in crime is kind of the most successful strategy of investing in real estate. It's easy to do it alone, it's way better doing it with somebody else.
Definitely.
I had another client reach out today, so what if I want to buy a multifamily in Cornwall? Well, you're talking to the right guys, because they might know how to do that.
Should have, Randy.
Thanks, Bob. There are a handful of, Cornwall's a really great place to actually invest. I had a conversation with a client today about it. We were taking a look at, where it is, right in the 401, in between two major cities. Looks like obviously it's poised for growth. From a lending point of view, it's not too far north that a lender would kind of shy away from it. The population is there. The industry is there. It is one of those emerging markets that are going to be good to invest in, especially for multifamily. It can be a commuter city. You're about an hour from, I think it was Kingston, Ottawa. So it's a great place to be able to invest in my opinion, in regards to financing options. Maybe you can touch on that.
Sure. Yeah, so depending on what you need to do to the building, if it's a turnkey building, then obviously we have the conventional lenders that we can go to if the rents are there. It obviously, a lot of the more creative ways or renovation budgets, if you need stuff like that, is more location dependent, but like Josh said, it is a good location. So at the end of the day, if you need renovation funds and you need a clear exit, with that unit count, you're probably going to CMHC if you want to. So we kind of map that out from the very beginning and just get you into something that allows you a prime, so an interest only, to be able to do the project, and then we'd be looking at an exit through CMHC at the end of it. And it's kind of one nice mapped out, planned out strategy, and there'd be no problem, especially with the lender we use.
Yeah, understanding the fundamentals about moving in and out of capital is, I think, the most important part that most investors are missing when they take a look at this type of acquisition. So understanding the products available to actually purchase. You don't always need to go private, even in a situation where you might have vacancy. There are some alternative lenders out there that have much better rate and fee structures, more flexible terms, and they allow you still to move into CMHC. And CMHC, you don't have to move into it. Just right now, it's extremely aggressive on the rate side and allows you to be able to maximize your equity takeout. Not everybody is in the business of taking out maximum equity and levering up and having it max amortization, but we're seeing numbers right now in the low 7s, mid to high 6s in up north on the multi side. So it is still expensive when you start to compare it like a 4.5% rate. Even if you took a 25-year term, the cash flow on that would be astronomical. If you're going to hold the asset for a significant period of time, in more than 5 years, I'd say definitely take a deeper dive into it. And we are working on creating something really special for everybody, whoever's watching this. We're going to have a really detailed plan for you about how we go about transitioning in and out from the get-go. You're going to go through your pro forma, your purchase, the different options available, how different rates and amortizations affect your equity takeout, point distributions on CMHC financing. We're digging deep into how we can make this more streamlined for you, because we understand that this is complicated for most mortgage brokers. Nevertheless, people who are looking to actually get in and do this. So, we're trying to add as much value there as possible. But the multifamily space, everybody's moving there, and I think they're going to continue to move there.
Definitely. And the one thing I would say too, like when you're looking in areas like that that aren't like considered major markets, is just making sure you hit your cap rate. So a good approach we take when we do underwriting is just making sure we put a couple cap rates. That way you kind of know your range and you know your low, you know your high, and I mean, we like to obviously be conservative all the time, but you just want to know when you're in areas like that, your cap rate might not be as great as it is down here and lower as it is down here. But we'll map that out and figure it out. We'll use CMHC to figure that out and just make sure it's all good to go.
Yes, sir. We had another question. So, what if my lender pulls out last minute? This is the worst situation that could happen to a broker. Never lets yourself. Obviously, we pride ourselves on having relationships with lenders, and our relationships obviously allow us to do things that maybe other brokers can't do. But sometimes situations happen out of our control, and the lender may find something that was either different than maybe they had thought, or they go through the house and the house has some fundamental issue with it. Something may have come up last minute and the lender pulls out. And this situation is pretty dicey because you're usually up against the clock when it comes to closing. If you're closing, if you're on a refinance, you're in a little bit of a better situation because the liability is less. But you're going to instantly want to get an extension on your purchase.
Yeah.
And if it was something fundamental with the house, that might put you in a stronger situation to speak to the actual seller because maybe it wasn't something you noticed.
Yeah.
So have that conversation with your real estate agent as well as the seller. Buying time is going to allow us to be able to find another option. Most conventional options are 30 days to close, sometimes 2 weeks if you can sell your soul. When it comes to private options, they can close within 3 to 5 days, depending on the lender that you are with. But it can be a dicey situation. So depending on the type of asset, be it loan amount, location, loan to value, all these things play a role into what type of lender would actually be able to execute on something that quickly.
Yeah.
I'd say convening the power team as fast as humanly possible and come up with a solution. Each solution is different and unique. It's never a great situation, but if you have strong people in your team who've done it before and who've gone through it and you have experience dealing with it, calm, cool, and collected heads usually prevail.
Yeah, and it really depends too, like on how unique the loan is itself. I mean, we always try to have backup plans ready to go just in case, but when you get so far into something and there's a commitment issue, I mean, you don't want to just go around to every lender and get a commitment across the board because obviously there's reputational risk and there's also the fact that nobody likes that and it's kind of like crying wolf. So it's like when you have a very unique project, everybody tries their absolute best to make sure it's good to go, but at the end of the day, every commitment that's signed has some sort of backup clause that says we can leave before closing, which puts investors high and dry. And honestly, it's the worst situation to deal with.
It is.
But yeah, like Josh said, like just open communication right away. Let your lawyer know. Let your lawyer deal with it. That would be like the easiest way. I know a lot of agents like to step in, but I think lawyers at that point is what they're there for, is to have that calm, cool, collected, removed head to be able to go through it and make sure that it's not emotional. They're impartial. So at the end of the day, everybody has some reason to sell that house. So it's just best to leave it to the lawyers and let them do their thing. It's what they go to school for. And yeah,
What do you pay them for?
it's what you pay them for, yeah. So
yeah, it's 100%. Yeah, I mean, there's a handful of weird situations that we deal with on a daily basis.
Honestly, this spawned from a potential idea of something called effed up finance, and then we decided maybe a catch-all because there's so many things that happen, but we also want to be able to interact. So, I mean, we tried to gather it all. That might still be in the works for sure. But yeah, so much shit happened.
Yeah, this is just kind of like a raw version of like what we deal with on a daily basis.
Yeah.
So as we continue to go through our week, we'll compile some situations that we go through, and we'll just talk to everybody, let them know what's going on. So what if we don't have any questions? That's up to you guys. You guys can just honestly send some questions to us throughout the week. We'll post and ask you guys for your opinion. And we'd really love to hear some feedback. We'll just keep it going. We'll keep the conversation open. If you guys want to maybe collaborate, we on Instagram, you guys can actually ask to join us. So if you're on here right now and you have a question, you can ask to join us, and we can actually have a conversation if you have a quick question. But really appreciate everybody tuning in for this episode. If you do have any other questions, feel free to reach out to either Nicholas or myself. We're happy to answer them.
Amazing, guys. Thanks for tuning in again. We'll see you next week.
Adios.
Oh yeah, this is that point. This is that awkwardness. What's up, guys?